Statistical arbitrage rests on a single, unexamined belief: prices will revert to their mean. But this faith has a hidden flaw. The time scale of reversion is unknown. In this analysis, we dissect this assumption, its theoretical cracks, and why matching time horizons is the only real edge. Every statistical arbitrage strategy, whether pairs trading, basket trading, or factor models, shares a foundational premise: prices are mean reverting. This means that after a deviation from an average, prices will eventually return to that average. The strategy profits by betting on this reversion. But this assumption is rarely questioned. It is treated as a law of nature, not as a hypothesis that can fail. The standard model for mean reversion is the Ornstein-Uhlenbeck process. It describes how a variable, like a price spread, drifts back to a long-term mean. The key parameter is theta, the speed of reversion. A high theta means fast reversion, a low theta means slow reversion. The problem is that theta is not constant. It changes with market conditions, and it is extremely difficult to estimate accurately. The fundamental issue is that mean reversion has no fixed time scale. Some price deviations correct within days, others take months, and some may take years. In extreme cases, the deviation may never revert. This uncertainty is not a minor nuisance, it is the core risk. A strategy that assumes a 2-week reversion will bleed money if the actual reversion takes 6 months. Keynes's warning is a cornerstone of risk management. It applies directly to statistical arbitrage. The market can stay irrational longer than you can stay solvent. This is the time-scale mismatch in action. Your strategy may be right, but your capital may not last. Consider a strategy that wins 90% of the time. It sounds excellent. But the 10% of losses can be catastrophic. If those losses occur when you are leveraged, they can wipe out your entire account. This is the risk of ruin. A strategy with a high win rate but a fat tail of losses is a time bomb. The mean reversion assumption may hold in the 90% of cases, but the 10% can kill you. The risk of ruin can be quantified. It depends on the win rate, the payoff ratio, and the fraction of capital risked per trade. If the win rate is 90% but the average loss is 10 times the average win, the expected value is 0. With leverage, the risk of ruin increases dramatically. This is why matching time horizons is so important. The solution is not to abandon mean reversion, but to match the time scale of the strategy to your capital duration. If you have short-term capital, you need fast mean reversion. If you have long-term capital, you can afford to wait. The mismatch is the killer. This is the real insight of statistical arbitrage. Mean reversion fails in structural breaks. When a company's fundamentals change or a market regime shifts, prices may never return to their old mean. This is not a temporary deviation, it is a new reality. A strategy that assumes reversion will keep losing money. The only response is to recognize the break and adapt. We can model the expected profit of a mean reversion strategy. The profit depends on the size of the deviation, the speed of reversion, and the holding period. If the holding period is shorter than the reversion time, the expected profit is negative. This is the mathematical core of the time scale problem. To evaluate a statistical arbitrage strategy, you need to track several key metrics. The Sharpe ratio measures risk-adjusted return. The hit rate is the percentage of winning trades. The maximum drawdown is the worst peak-to-trough decline. The time to reversion is the average time it takes for prices to revert. These metrics help you assess whether the strategy's assumptions hold. Statistical arbitrage is not a set-and-forget strategy. It is a bet on a specific time scale of mean reversion. The market can and will deviate from your expectations. The only way to survive is to test your assumptions, monitor your time horizons, and manage your leverage. Do not trust the faith, verify it. We appreciate your engagement. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.